Thank you for joining us today for this 2022 ARC PLC and crop insurance update sponsored by Plains Cotton Growers. My name is Shawn Wade and I'm Director of Policy Analysis and Research here at PCG. And the purpose of today's presentation is really just to kind of go over some of the things that we would like producers to consider as they go about making their crop insurance and Farm Service Agency farm program decisions for the 2022 crop year. Some of the things that we're going to cover today include some program linkages that we need to kind of keep in mind as we make our insurance and program decisions. Some of the important dates associated with the ARC PLC sign up and crop insurance purchasing. Then also just kind of give a little refresher over some of the ARC and PLC components, price, yield, revenue, some of the program interactions that do exist between the FSA and crop insurance programs. And then we'll kind of shift gears a little bit and move into the crop insurance aspects of our safety net. Once in there, we're going to discuss some of the just basic components of insurance that we keep in mind when we make those decisions each year. Kind of refresh our memories on some of the policy adjustment mechanisms and endorsements that producers have available to them as well to kind of enhance or modify their crop insurance safety net. So as we kind of get started in this discussion, I think the first thing we need to do is just remember that Congress has recently linked or limited participation in quite a few of our commodity programs to crop insurance. So when we look at farm bill programs like the agriculture risk coverage or the price loss coverage programs, we see that there are actual interactions between that and some of the crop insurance endorsements that you are eligible to purchase. So depending on the programs that you're participating in over at FSA, you may or may not be eligible to purchase one or more of the endorsements that are available through crop insurance. Another interaction that we need to really keep in mind for 2022, though, is the Wildfire and Hurricane Indemnity Program, or WIP Plus program. That's a disaster program that provided benefits to growers for losses that they incurred in 2018 or 2019. And producers that receive benefits under WIP Plus are required to purchase a federal crop insurance product at a minimum 60% coverage level for the two next available consecutive crop years following the year in which they actually received those WIP payments to begin with. So if you received a WIP payment in 2020, you would be having to purchase a 60% level policy on insurance in the 2021 crop year, and then again this year in 2022. If you did not receive any WIP benefits until the 2021 crop year, for instance, maybe you only received benefits through the quality loss adjustment program or something similar, then you may have not received any benefits until 2021, in which case that 2-year requirement would begin in 2022 this year and then extend into next year, 2023, for that 60% coverage level. As we look at some of the deadlines that we kind of need to talk about, some of the dates, the first one to keep in mind is the Farm Service Agency's ARC PLC sign-up deadline. That is March the 15th. And I know that FSA has certainly been very eager to get your enrollment decisions completed, but a lot of producers have opted to kind of push that decision off until they get a little bit better idea of what the crop insurance projected price may be for 22. And I think that's a good idea. Because of those delays, though, it may be necessary for some counties to utilize registers to complete that ARC PLC sign-up process. And so just keep in mind that if and when you are added to an FSA register, they will require you at that time that you're placed on the register to provide them with your ARC PLC decision. So be prepared to make your program choices known by March the 15th. FSA has made it very, very clear that the purpose of the register will be to complete the paperwork, not to give you any extra time to make your decision. So we definitely want to be prepared and ready to go on March 15th to let the FSA offices know what our decisions will be in regard to participating in the ARC or PLC programs. On the insurance side, of course, we've got our insurance discovery periods and sales closing dates. Here on the plains, the area colored in green on the map there, we see that March 15th is our sales closing date. And if you look down at the bottom of the list there, you'll see that our price discovery period for the projected price began February the 1st, yesterday, as I'm recording this, and will extend through the month of February till the 28th. And also remember that to set that projected price, RMA utilizes the commodity exchange price provisions that for cotton specify monitoring the December 2022 ICE upland cotton contract and then averaging those daily closing values. So as we begin the month of February right at $1, we will be watching that process very carefully as we move forward. Of course, the February 28th sales closing dates, for those of you that may be watching this from outside of our area, that discovery period ends February the 15th and has about 2 weeks to go on it as of the recording of this presentation. So when we think about, what are we going to do for our safety net? I think, the big question that we'll ask throughout this presentation is, where do we think prices are going to go in 2022? That's especially important when we are considering our FSA program options. For instance, the price loss coverage program, which provides price-only protection through the FSA office. We remember that for seed cotton, the trigger point for that PLC payment to begin would be the reference price of 36.7 cents. And what we do is we actually will compare that reference price to the market year average price received once it is completed and that calculation is made. Of course, we won't know what that market year average price is until sometime in early fall 2023 as we get through the marketing year. But I think if we look, at today's prices and project where some of our futures prices are looking for the 2022 growing season, we can see that the price loss coverage program may be a program that really is going to provide us much less protection than it normally would since we're at these higher price levels. PLC obviously is a very inflexible program, but it does come at zero cost, and again would protect us really only against a very extreme price decline as we look at 2022. If we kind of look at some of those forecasted prices, you can see on the current year's prices compared to the reference price on the top line there. We see the FAPRI and the FSA market year average price forecast for 2021 right at 46 cents per pound for seed cotton, which would be about 10 cents, almost 10 cents over the reference price for the PLC program. And if we look forward into 2022, really the only current forecast we have is from FAPRI, those folks over at the University of Missouri, and they are currently forecasting a 41-cent seed cotton price for the 22 crop. That still is about 5 cents over the reference price for seed cotton and would indicate lower chances of PLC paying a payment on the 22 crop when we get to that point. Another way to kind of think of that reference price for those of you that still get a little confused on, what is that combination of seed and lent to get to 36.7 cents. If we look at this chart and see the highlighted areas in yellow there, when we look at seed cotton prices, that combination of lent and seed that gets us to that 36.7 is highlighted basically in the yellow squares. And you can see that when seed is between $210 and $250 a ton, the lent price that corresponds with our 36.7 cent reference price for seed cotton is somewhere between 68 and 72 cents. So that's very much below, where our current December futures are as we look forward to the 22 crop. Almost 25 cents a pound higher on the lent side. If we assume that seed is going to stay in that $210 to $250 a ton range. So again, at current prices, the seed cotton reference price is going to be well below what a currently forecast seed cotton price might be given current lent and seed price forecasting. Carrying forward in the FSA programs, next up would be the agriculture risk coverage program. Of course, ARC comes in two flavors. We have the county-based program and then the individual program. We're going to focus on the ARC county program today, and just remind producers that the trigger point for the ARC county payments is the expected county revenue. And that is a combination of that county benchmark yield, which you'll see is a 5-year Olympic average yield, multiplied by a price. And that price would be the higher of either a 5-year Olympic market year average price for seed cotton or the seed cotton reference price. As it happens for 22, as we look at the FSA information for the ARC County program, we see that for seed cotton, the price that they will use is in fact going to be that seed cotton reference price of 36.7, and that is because all of the years ahead of the 5-year Olympic average that would be used in that Olympic average were actually below the seed cotton reference price. So for ARC County, again, it's going to be that reference price times our 5-year Olympic average yield. Another thing to remember about the ARC County program is that it can be a split offer, either as irrigated and non-irrigated payments, or an all cotton offer, just depending on the county. So you'd have to look that information up on the FSA website, or contact your county office to determine whether or not it's an all cotton offer, or whether or not it would actually be split irrigated and non-irrigated. And we'll talk about the implications of that being split by practice a little bit later on. Again, the ARC County program is going to be pretty much less flexible compared to insurance. Again, it doesn't have any costs associated with it, but it is because it's based on that seed cotton reference price on the price side, and that county benchmark yield, likely to provide less income against anything except an extreme price decline, assuming a county made its average yield or near its average, or an extreme production failure. And in the event that the prices are actually significantly higher than the reference price, it would require a much deeper loss at the county level to trigger an ARC County payment as well. So we'll talk about that a little bit more later on when we look at some of the ARC County offers in our examples. As we look at this interaction, we mentioned earlier that there are program interactions between crop insurance and our FSA farm programs of PLC and ARC. And so the first thing we kind of need to keep in mind is the difference between an ARC PLC election and then the ARC PLC and the actual enrollment and participation in those programs. So the first thing a producer is asked to do is actually choose the program that they want associated with their farm. And that is, again, enforced by FSA farm number. And then once they make that election, they will determine whether they actually enroll to participate in the program for that crop year. So as we look at that, we see some interesting interactions here that exist based on how Congress put the last farm bill together. As we look on just in the rows there under the elections for PLC and ARC, you'll see that a PLC election doesn't impact you in any way when it comes to stacks, the supplemental coverage option, or the enhanced coverage option endorsements under crop insurance. And on the ARC County side, the only interaction that comes with an election of ARC County or ARC IC individual is actually with the supplemental coverage option endorsement. So if you elect ARC County, whether or not you enroll, just the election of Ark County would actually make you ineligible for SCO on that farm number. The last two columns there under enrollment, you'll see that when it comes to the stacked income protection plan, the actual enrollment to participate in PLC or ARC, both of those programs, participating in them at FSA would would make you ineligible for stacks on that farm number. Whereas enrollment in Ark County would actually make you ineligible for SCO. If you are enrolled in PLC, you would see by the green check mark, still be eligible for the SCO endorsement through crop insurance. And then with the ECO enhanced coverage option, there's actually no interaction and no limitations on farm program participation to purchase the ECO option. And we'll show you some examples of the cost of that program as well. So the main thing that we need to remember about this interaction, and whether you elect PLC or ARC or enroll in PLC and ARC, is that the snapshot date to determine that enrollment status and participation status is actually March the 15th. So you remember back when we talked about the registers, when they put you on a register, they will actually ask you as of March 15th, what is your intention? Do you want to have ARC or PLC as an election? And then they will ask you about your intent to enroll as well. And then that paperwork would be completed as of March the 15th would be the status date. So that's very important to remember, as it does have some impact on what you can do through crop insurance. Also remember for FSA programs, our acreage reporting date is July the 15th for pretty much all of Texas, except for extreme South Texas, where it's March the 15th. So acreage reporting date's another important date to remember, because that's the date that you will actually make your acreage report to the federal crop insurance program as well. And then they will take that planted acreage data that you've got, look at the policies that you have on your and endorsements that you have on your policy, and then compare that back to your March 15th snapshot date on the FSA side to determine which crop insurance products actually come into play for you for the 22 growing season. Another thing to kind of keep in mind is that you are allowed to have stacks, SCO, and even ECO, all three on your policy at the same time. And you may certainly want to have them on your policy and available to you if you are thinking about not participating in any of the FSA program options for 2022. Things to remember there is that stacks and SCO and ECO would only attach to those insurable cotton acres on farms that are not prohibited by one of those exclusions we just discussed. And if you have any questions about that, certainly would encourage you to feel free to contact us here at Plains Cotton Growers. Just rewind the video, freeze it on that chart, and see where you might be as far as eligibility wise for stacks or SCO. So you just need to keep this in mind. That if you make a program decision at FSA that makes you eligible for one or both of those products, then if they're on your policy, then they would potentially attach and be in force for the 22 growing season. And again, RMA is going to use that information that's provided by FSA as of March the 15th to determine what you would be eligible for the different crop insurance products that you would have available to you. So using that as a bit of a segue, we'll kind of look at some of the insurance policy things that we need to be considering. Again, the magic question there is, what are prices are going to do? And I think one of the big pluses for insurance products in this environment that we have today is that the coverage is going to be based on current market levels and not that fixed seed cotton reference price that the PLC and ARC programs would be leaning on. As you know, we have a lot of different policy types and enhancements that are available to us. We can buy a revenue plan of insurance, a revenue plan with a harvest price exclusion, as well as just a basic yield coverage plan. This provides us a lot of flexibility to hopefully strike the best balance between cost and coverage when it comes to our 2022 safety net. Some of the endorsements and things that we will kind of keep in mind here that are available to us. Of course, the cottonseed endorsement is a very popular add-on that most growers in this region have taken advantage of, and provides them some additional coverage based on the value of their cottonseed when they have a physical yield loss on a farm. And then we have the other endorsements that are available to us: the Stacked Income Protection Plan, or STAX, the Supplemental Coverage Option, and then also the Enhanced Coverage Option, which was a new product that first became available a year or two back. Within the policy itself, of course, we have some yield adjustment mechanisms that we can use to enhance the amount of our coverage. Of course, we have yield adjustment, which is our standard yield plugs that we've had for many years, that allows you to substitute a plug yield of 60% of the county T yield for any year where your actual yield is below that level. But then we also have two other things that we can utilize. First off, the yield exclusion, which would allow us to actually drop years out of our APH calculation if the county qualifies. And then the trend adjusted yield, which is an ongoing adjustment factor that provides some mechanism to adjust yields for, advances in technology and seed and whatnot as we go forward. The other major things that we really are going to look at when it comes to our crop insurance policies, besides the type of policy, is, what coverage level are we going to look at purchasing, and how does that subsidy amount, premium subsidy that goes along with those coverage levels, balance that cost with the coverage that we can purchase. And playing into that as well is, our unit structures, where we have, the more traditional optional units, where each kind of farming unit can kind of stand on its own, a little bit higher cost, or the enterprise unit, which would allow us to, aggregate all of our similar practices, all of our dryland or all of our irrigated cotton under a single enterprise unit in a county, and then provides a higher subsidy amount. Enterprise units, of course, coming with an 80% subsidy up to that 75% coverage level. So unit structures, coverage levels, balancing that against, our subsidy amounts and how much coverage we can buy. And then, how do we utilize these endorsements and other policy adjustment mechanisms to really enhance our safety net and give us the best opportunity to protect, our potential revenues at the prices that we're seeing today. A little bit of a kind of refresher on the STAX protection plan. Of course, remember, STAX is an endorsement that can be added onto either a yield or a revenue policy that does provide coverage for the producer over and above their underlying policy. And then that comes with a premium subsidy of 80%, so it makes it a very affordable policy, and then provides coverage from 90% of the county's expected revenue down to 70% of that expected county revenue. So a nice 20% band of the county's expected revenues can be covered. And actually, there's also a multiplier of 1.20 that can be utilized to further enhance the amount of coverage we can purchase. Of course, we can buy that on top of any revenue or yield insurance policy. And then that premium subsidy for that underlying policy would vary by the coverage level that we are purchasing. And coverage levels, again, are available between 50% and 85%. But remember, because of that WIP plus interaction, most of us are going to be looking at a minimum 60% coverage level for 2022. Just kind of to give you a visual reference of how that STAX coverage would kind of interact with your underlying policy. If you look at the graphic there on the left-hand side, we see an example of displaying a 70% policy of insurance, and then our normal deductible, which would be anything above that 70% line up to 100%. That would be the typical deductible that we would have to meet before that policy began to pay. When we put stacks on top of this, though, we see that that deductible is shrunk from 30% down to 10%, based on the county's experience. And then as the county's experience falls below that 70% line, we would approach the maximum insurance payment that might be available to us under stacks. The only real limitation with stacks is it can't overlap with your underlying policy. So if you were perhaps to buy a policy of insurance greater than 70% level, that would just narrow that stacks band in that 5% increments. So you might, if you bought a 75% policy, have coverage from 90 down to 75%, or 15% band. So stacks is a really good product. If you're very similar in nature, your APH is very similar to the county, you track close to the county, it's going to line up very well. However, it may or may not trigger because it does not rely on your underlying policy in any way on whether or not an indemnity is paid. So you could have a situation where you had a loss under your underlying policy, but the county does not, and stacks might not pay an indemnity, or you might be in a situation on the other side of that where the county experiences a loss and triggers a payment under stacks, but your individual farming operation may not have incurred any loss at all. So it's a little bit separated, I think, from, is the best way to say it, from your individual experience, but does give kind of a very good mechanism to capture either the effects of an area-wide production impact, such as drought or maybe a widespread hail, but certainly on the price side would give you the opportunity to capture some of that price decline from wherever the insurance's projected price might be. And in this instance, we might be looking at something above $1. So, any price decline below that projected price would, pretty quickly begin to trigger a payment, even if the county essentially matched its average expected yield. So stacks is a pretty good option for growers, pretty cost effective, and something that I think a lot of people are going to be looking at in 2022. And we'll see some specific examples of costs and coverages that are available in a few different counties when it comes to stacks a little bit later on. The other endorsement I'd like to kind of just give you kind of a refresher on is that supplemental coverage option and the new enhanced coverage option. As you can see, the ECO plan provides either a 44% premium subsidy if it's a revenue coverage, or a 51% premium subsidy if you are purchasing just the yield coverage side of that. And then it provides you two different levels of protection, either with a 95% trigger point or a 90% trigger point. And then the coverage band would go from those two numbers down to 86%. So under the ECO plan, you could purchase either a 4% band of coverage or a 9% band of coverage, just depending on whether you chose the 90 or 95% trigger levels. And you can see how that kind of sits on top and creates a very small deductible. And again, to remember, the ECO product does trigger on the county's experience. Supplemental coverage option is the other kind of add-on that you could put in conjunction with ECO. ECO would essentially sit on top of that coverage band that's provided by the supplemental coverage option. SCO comes with a 65% premium subsidy, so a little bit better premium subsidy than ECO, and provides you coverage from 86% down to whatever your underlying plan of insurance might be. So you could purchase the supplemental coverage option and get a coverage band between 86% down to 70% in our example here, or if you bought a 60% policy, from 86 down to 60%. The unique thing about the supplemental coverage option that does make it somewhat attractive, even though it's a little bit more expensive than the stacks when it comes to the difference in premium subsidy, is that while SEO does trigger based on the county's experience, your actual coverage is based on your own individual APH. So when SEO triggers a loss because the county experienced either a revenue, price, or yield loss, then the calculation is just how much of a percentage of loss within that SEO coverage band was incurred. And then that percent is then translated over against your expected revenues based on your APH and the insurance price to determine your actual indemnities. So it's one that, again, from a triggering standpoint, both ECO and SEO are based on the county's experience. ECO simply covers and pays based on the county's yield or revenue, but that supplemental coverage option does provide you a little bit of personal coverage in that the amount of your insurance is based on your expected yields and revenues. So that is kind of just a quick and dirty overview of supplemental coverage option. We'll kind of show you some examples again when we get to those to kind of illustrate, what the differences are between SEO and stacks, for instance, where you have similar coverage amounts. As we move, with forward into this process, though, there are a lot of some assistance out there that producers can turn to. One of the better ones is the Texas A&M Agriculture and Food Policy Center, the AFPC folks down at Texas A&M. They do have a 2022 ARC County and PLC decision aid tool. Of course, they're very easy to find. You can go to their homepage there on the screen, afpc.tamu.edu. You can also reach them by phone at 979-845-5913. Or you can go straight to the PLC, ARC PLC decision aid tool itself, utilizing the link that you see there. That'll take you directly to that decision aids login page. And if you've already participated in the AFPC program when we were putting together the last farm bill, many producers have already established accounts when they were making some of their early farm program decisions on base reallocations and whatnot, and already have a login for that. If you have a login, then you can simply go to that page, put in your email address and your password, and be taken directly to the information that you already have stored on their servers. Should have all of your base and payment yield and historical irrigated percentage factors already input there. If not, you certainly will have an opportunity to update or change that information as well. This screen is just a screenshot of the homepage there at the AFPC. You'll see the red arrows pointing to first one there on the top is the 2022 ARC County PLC decision aid. So you click that link and that will take you directly to that login page that I just mentioned. If you're looking into the ARC individual program, there is a link there just below that. That is an Excel evaluation tool. So it's an Excel spreadsheet that would help you kind of look at the ARC individual program and see if that might be something of interest to you. So as we look at the ARC PLC decision aid tool, the screenshot there on the left-hand side just is kind of what you'll see when you go straight to that login page. You click the link and you'd just be asked to put in your email address or password. If you don't already have an email address, when you click that login link, it will give you an ability to create a new account to begin that process of utilizing the tool as well. Once you get into that tool, then you'll maybe see a screen similar to the one on the right there, where it would allow you to edit a farm, either adding a farm and putting an identifier on that to kind of begin getting all of your information into the tool that it would need to create those estimates of potential payments based on your farm setup. When we going through the process, this is kind of a small page, a little bit hard to read. I've got a blown up version. I'll kind of split the page in half, but this would be kind of the expected payments page. And you can see when we look a little closer, sorry, this is a little bit blurry, but the top part of that page would see when you signed in. If you've already got farms put in there, it would show you a farm, what that farm serial number is, the state and county that it's located in the crop. And then lower down on the page, if you've already got the information entered, it would give you, show you what the base acres you have associated with that farm number are, what the PLC payment yield is for that farm, and then potentially also what your historical irrigated percentage might be for utilizing, the ARC County program when we have a split irrigated, non-irrigated offer. Again, those are all editable fields. Most of them will be pre-populated if you've already got information in there, but certainly you could update some of that information and make some changes there. You'll see at the bottom portion of that deal of the page shows your price expectations. You can certainly use the projected prices over on the left hand side of that page. Or I should say on the right hand side of that page. And you can certainly click the button to just use the projected prices that they have kind of preloaded into the system. If you want to look at what would happen, given a different price outcome, you can on the left hand side there put in your expected price and kind of see what it would happen, at different price levels when it comes to ARC and PLC. You just hit that recalculate button, and then the program will go through an iteration of simulations to provide you some results. And if we go back to the first page, what you'll see is that the decision aid itself is actually creating proper probabilities of different levels of expected FSA payments here. And they do that running 500 different possible future combinations of prices and county yields to kind of give an expectation of what might happen to payments given these different possibilities. And then those values would display what the possibilities might be within a range. They wouldn't be an actual payment amount, but do hopefully provide you some idea of what might be in store for us at given price levels. To look at that output though, this is kind of what you would get once you push the recalculate button. You'd see that it calculates potential payments for both PLC and ARC, and then if that county is irrigated and non-irrigated split out, you would see different payments there. In the circle, you'll see that those payments are listed there for 2022, and they have a dotted line underneath them. If you click on that number, it will actually show you the details of what that potential payment might be. And I think that the main thing to remember about the numbers that you see on this page here, especially in that top box, is that this is the mean payment expectation. So what that means is out of all those 500 runs, this is the midpoint of the payments that were potentially calculated. And so it certainly isn't an average payment by any stretch of the imagination. It is simply the midpoint of the different range of possibilities that were returned by the calculator. And when we look at that again, when we click on that number and get the payment details, if we look there on the left hand side where it says PLC payment details, you'll see that mean payment is 1309. But you can see as we look at those percentiles, that really those payments don't begin to kick in until somewhere around 80%, the 80th percentile or lower. And that just means that more than likely there's less than a 20% chance that a PLC payment would be generated given the current price forecast of 41.04 cents that we saw on the previous page. So as you know, that's the way to look at these this detail sheet is that 10th percentile down to the 90th percentile. The lower those numbers are within those percentile groupings, that means the lower chances of a payment might be made. When we look at the ARC returns there, we see there was an irrigated potential payment of 54 cents and then $54 and then $27 for non-irrigated. We look at the details there and you'll see on the irrigated side that there's zeros all the way down to the 90th percentile, which means essentially that mean payment that they're showing there of $54 an acre, probably much less than a 10% chance that would actually occur given the current price and yield forecasts, given expectations for relatively normal production. On the dryland side, that $27 mean payment you can see is right around that 90th percentile, so still only about a 10% chance or less that an ARC County payment might be made in this example. So please, keep that in mind when you're looking at these numbers. It is only the mean of kind of the price potential payments that could have been realized, and you really need to click on that detail and look at those percentiles and see what is the actual percent odds that we might actually generate a payment. And you'll see that for virtually every one of these programs, it's less than a maybe 10 to 15% chance that we would actually see any payments derived through PLC or ARC in 2022, given the parameters that were put into the calculator for this example. So that's an important thing to remember. Now I think with that, I think the best thing to do is just maybe look at a few examples. So I've run a few examples. We'll start out with some irrigated examples showing a 60% revenue policy in Lubbock County with optional units. For my projected price, I did these a couple of weeks ago, so I used a 93-cent price, which was the price that was set for insurance in South Texas earlier in the year. Other details that I used a 1,000-pound APH and a 60% policy level with basically 100% planted acres. So when we bring this down to the per acre numbers, a 60% policy with a 93-cent price on a 1,000-pound APH would give us $558 worth of insurance. The premium subsidy for a 60% policy is 64%. So the government's going to be paying 64% of that calculated premium. And in this example, that would leave a producer premium owed of $31 per acre. So that's $31 cost for $558 worth of coverage under a 60% revenue plan in Lubbock County. And I tried to keep in these examples, I tried to keep the APH and the price pretty consistent so the coverage amounts are pretty much the same. And you'll just really see the difference between the producer premiums and the rates that might be incurred in different counties. And we can certainly find other examples to get a little bit more specific, but I would really encourage everybody to kind of get their insurance folks to run them some quotes at that 65% level, and then compare that with a Stacks or an SEO quote to kind of really get a good feel for what you might be looking at when it comes to your coverages. So with that basic revenue plan information out of the way, let's look at the Stacks insurance line column there. And again, we're going, since we have a 60% policy, we could buy the full band of Stacks from 70 to 90%. And then with a 120% multiplier, a 93-cent price. That county expected yield for Lubbock County irrigated is 878 pounds. So when we do the calculation on that, that would give us a Stacks, maximum potential Stacks payment of $195.97. And again, Stacks comes with an 80% premium subsidy, which helps make it pretty affordable for that upper level coverage. And our producer premium for that Stacks policy would be $17.42. Again, The benefits of insurance compared to our FSA programs is our insurance policies, stacks, SEO, ECO, and our underlying revenue or yield plans would all be covering 100% of our planted cotton acres with this level of protection per acre. When we look at the blue headed columns there for PLC and Ark County, of course, PLC, we know based on price only, 36.7 cent reference price. We know that that price would be well below that 93 cent limit price. Going to take a pretty steep price decline for PLC to kick in. But what I really want folks to kind of focus in on here is the Ark County column to show, kind of what kind of protection we could get through the Ark County program as well. And you can see that for Lubbock County, again, that price that's used for Ark is going to be the same as the PLC reference price. The county's benchmark yield is 1,970 pounds of seed cotton per acre. And that 10% coverage band from 76 to 86% that you would get with Ark County would calculate to a maximum payment rate of $72.32 for irrigated cotton in the county. Now, when we look at those FSA farm program options, again, remember, they don't get paid on planted acres. PLC and Ark would both be paid on a maximum of 85% of your seed cotton base acres. And then further potentially limiting those payments would be on the Ark County side, where you would be actually multiplying that base times your historical irrigated percentage, that HIP number that we saw in the AFPC decision tool, one of the boxes on that decision tool. So if you have a HIP percentage of anything less than 100%, know that your Ark County payments would be then split between irrigated and dry land acres based on that percentage. So that historic irrigated percentage, for instance, you have 100 acres of base, historic irrigated percentage of 80%, you would have then 80 acres that would go towards irrigated Ark, and then 20 acres would be delegated over to the non-irrigated or dryland side of Ark. And then payments would only be paid on the practice that actually triggered a loss in the county. So if dryland didn't trigger anything on Ark County, those 20 acres, that 20% might not receive any payment at all. Whereas if you irrigated did trigger, you'd be eligible for that on that 80 acres, reduced by that 85% factor as well. So again, Ark County PLC going to be paid on less than 100% of your planted acres. And then you can see compared to stacks, the Ark County maximum payment is significantly lower at $72.32. And again, just remember with Ark County, again, that price of $36.70 means that we've got to have a really long price decline come into play before the Ark County program would actually get to the point that it could make a payment if it made its expected yield. And that 1,970 pound benchmark yield corresponds fairly well with the stack's expected yield. It's not exactly the same, but they're in the same general area. So, you'd be looking at very similar yield levels. Our next kind of irrigated example here for Lubbock County, we're going to stick with the same information when it comes to our underlying insurance policy. Again, that $558 guarantee and $31 producer premium. But then we look at the SCO and ECO options compared to Ark County. And the reason those are, I think relative and good to look at is that, again, they show that you can get significantly more coverage under the SEO or stacks plan than Ark County might provide, and certainly protects you at a much higher price point as well. When we look at SEO, we see that, again, the county's expected yield, same as stacks, 878 pounds, price the same, but that guarantee, when you have a 60% underlying policy, you've got coverage from 60% all the way up to 86%, and that actually translates into 26% of your farm's expected revenue. So that $241.80 coverage amount, that guarantee, that would represent 26% of this farm's 1,000-pound APH based expected revenue. We see that the premium subsidy, again, with SEO is lower than stacks by 15 percentage points down to 65%. And therefore, the corresponding cost is a little bit higher at $29.80. If we just flick back to the stacks example to kind of refresh that, we see stacks provided us almost $200 worth of coverage for about $17.50. SEO can give us more coverage by nearly $45, but comes at a cost of almost not quite double, but certainly significantly more, $12 more at $29.80. So a little bit more of an expensive option, but again, SEO gives you the flexibility to maybe still participate in PLC and at the FSA office that stacks would not. So there's a cost benefit there that producers would have to weigh, but certainly it seems that stacks would be, maybe from just a dollar cost and coverage comparison, balancing coverage for cost, stacks looks like a little bit better deal going into 2022 compared to any of the other options, especially the Ark County or SEO options. We'll talk just a little bit about ECO, and I'll have an ECO column in all of our other examples, but you'll see that ECO, again, lower premium subsidy amount, narrower band of coverage. So you're buying, a lot less coverage at $83, but still that cost is almost exactly the same as the amount of coverage cost that you would have had under SEO. So you're getting basically a third of the coverage under ECO that you would under SEO for basically the same cost. So it makes it a pretty expensive option to look at. I guess its main redeeming factor is that, it does come at a 95% potential trigger point, which is what we have in this example here. So it wouldn't take very much loss on yield or price for that ECO policy to begin to kick in. But again, just not a whole lot of coverage for the cost. You might be much better served to stick with, just either SEO by itself or stacks, and go with, either an 86 or a 90% trigger point instead of 95. Our next example is kind of up in the Panhandle, Moore County. You can see, again, try to keeping things straight. So for that 60% policy, 1,000-pound APH, that $558 guarantee. In Moore County, that's going to cost a producer $36.82 per acre. When we look at the stacks add-on to that, we see that stacks would provide us with $213.83 worth of coverage using the 20% band with the multiplier. And that's mostly a difference in that county's expected yield of 958 pounds when we look compared to Lubbock County. So that's a little bit higher, gives us a little bit more coverage. And then the cost for that stacks is going to be $25.82. So again, some difference in the premium rate as well. But not out of the realm of consideration. Again, that $25 would get us another $213, almost $215 worth of coverage. When we look over at the Ark County, that free FSA option, keeping in mind all of the baggage that comes with it, with the historic irrigated percentage, the narrow band of coverage, we see that benchmark yield a little bit higher than Lubbock County's. But you'll also notice that Moore County is an all cotton offer. So there's no differentiating between irrigated and dryland in Moore County. So all producers would be looking at the same regardless of the practice. And that would be a maximum Ark County payment of $74.11. Still, just roughly a third of the protection that you would be able to potentially get with stacks. And you would take almost the exact same amount of loss that a full stacks payment would be. that's what it would probably take on the yield side to trigger an Ark County payment. And again, if prices stay up, remember that county loss has to be a lot deeper for Ark County to begin to trigger because of that low reference price that's used to calculate those payments. Shifting over to the SEO and ECO options for Moore County. Again, you can see when we flip over to the stacks. Remember, the stacks had $213 worth of coverage for $25.82. When we look at SEO, again, you're going to get a little bit more coverage, $241.80 again, because that's that same 60 to 86% band on that 900,000 pound APH. But because of the difference in premium subsidy and rates, you'll see that the cost for that $241 of coverage is $36.32 per acre. So a little bit more expensive than it would be in Lubbock County. Looking at ECO, again, $83.70 worth of coverage, pretty low subsidy rate. And you'll see that the cost, the producer premium for that ECO is $36. That's almost 50 cents on the dollar, cost to the producer there for that coverage. So again, ECO doesn't look like a great option. SCO is going to be relatively more expensive than stacks, but still give you a good amount of coverage. And then, of course, probably the most economical choice would be stacks to look at if you're just trying to balance, additional coverage over and above your revenue plan of insurance, and to give you that extra bit of protection that may kick in a little bit sooner than our FSA program options. SEO and stacks, again, stacks probably going to come out a little bit ahead when it comes to cost versus coverage compared to stacks, compared to SEO. So kind of keep that in mind. And again, you just can't get too many quotes from your AIPs to kind of show what these interactions are going to be and kind of where you can find that sweet spot for your coverage. I would also note that in these examples I'm using on irrigated, these are all optional unit quotes. I've certainly had some producers express interest in going with an enterprise unit, even on some of their irrigated ground this year, and then maybe supplementing with a little bit of additional hail insurance. Probably something that's worth looking at. Certainly that enterprise unit with that better subsidy is going to allow you to maybe buy up to as much as a 70% plan of insurance with that enterprise unit at less cost. So getting even more underlying coverage at less cost that you can then kind of pair with stacks or SEO to get a little bit better fit to cover your needs. Last irrigate example would be Dawson County. Again, same yield and price and coverage level. So again, we're $558 worth of coverage. And you'll see the producer premium down there, $38.90. I think that just certainly indicative of, the differences in location. Down in that southern area, those rates are going to be just a little bit higher maybe than up north. So $38.90 for a 60% optional unit policy. As we get into these price levels, again, this is where producers really, are going to start maybe weighing the options of an enterprise unit to try and help them, get a little bit, get a good amount of coverage, but, at a reasonable cost. And if you can save enough money doing it that way, you can certainly hedge your individual risk on a farm by farm basis by adding some hail insurance to protect you against that individualized hail loss. As we look at the stacks, let's look at stacks here. 910 pound expected county yield, $203 of potential, that'd be the maximum amount of coverage you could buy through stacks, and a cost of $24.77. Still not too bad, a pretty good amount of coverage for that additional cost. And again, if you pair that with an enterprise unit, you can maybe keep that to a pretty reasonable amount of insurance coverage for cost kind of relationship. When we look at Ark County as a comparison to stacks, You'll see that that benchmark yield is pretty good, 2,268 pounds seed cotton. So the maximum, that 10% band of Ark County coverage, that maximum payment would be $83.27 for irrigated. But again, it would be an irrigated offer, so you might have that historic irrigated percentage come into play, and certainly that would be an amount that would not be covering 100% of your planted cotton acres in 2022. So that's how kind of Ark County shapes up for Dawson County in this optional unit example for irrigated. When we look at the SEO, again, you got that high level of coverage, $241.80, but that cost, again, creeping up because of that higher rate that we would see associated with Dawson County, $39 cost for that $241.80 worth of coverage under SEO. And then on the ECO side, you've got a different number that we would be looking at there. For the non-irrigated side, I did two different ones. I ran some optional units just to kind of see how that cost shapes up and then compare that with stacks and SEO. Let's start with Lubbock County optional units. Again, that would be at the 60% level. You can see the yield is set at 400 pounds for the APH. Full disclosure, these quotes were run with a 250 pound rate yield, which would indicate some benefits from either the yield plugs or yield exclusion or trend adjusted yields to move that insurable yield up to 400 pounds. So we did enhance the yield a little bit here to get that coverage up to a reasonable amount. With a 60% guarantee in that 400 pound APH, we would be looking at $223 worth of insurance under that revenue plan, and then a producer cost of $38.88 per acre for that $223 worth of coverage. When we look at adding stacks to that, again, you're eligible for the full band from 70 to 90 with the multiplier. 257 pound county expected yield would give us a maximum stacks payment of $57.36 if we triggered the full band. But with the subsidy, again, pretty reasonable cost, $7.19 additional cost from a premium standpoint. When we look at Ark County for Lubbock County, on the dryland side, we see that benchmark yield is fairly low, 630 pounds, but again, kind of in the same ballpark as the stacks expected yield on a limp basis. And with that lower seed cotton reference price used to calculate the benefits, a maximum 10% band value of $23.14 if it triggered a full payment. Again, not payable on 100% of your base because we're either going to be reduced by 85% or 85% plus the impact of that historic irrigated percentage. So again, not on 100% of your planted acres like our insurance options. SCO and ECO in that Lubbock County example, again, the underlying coverage stays the same. SCO gives you just a little bit more coverage than the stacks. You can see it goes from $57 to $59.52. But again, that lower premium subsidy is going to kick in, and it ends up being about $5 more expensive for essentially the same amount of coverage that you get under stacks. Really, the only difference being is the fact that you've got a little bit lower trigger point at 86% with SEO compared to the 90% trigger at stacks. And then, those bands of coverage are actually fairly close together value-wise. We look at ECO, again, that's going to be the more expensive add-on there to get a 95% trigger point on that county's expected yield. $33.48 worth of coverage for a cost of $14. So again, almost 50% of your insurable value there would be eaten up by the producer premium. So not really a very cost-effective option when it comes to SCO to the ECO option under dryland situation. Moving up north to Moore County, you can see I changed the yield up a little bit for Moore County just to kind of be a little bit more reflective of maybe what they're looking at up there. Move that up to 550 pounds using a 350 pound rate yield. So still some impact there from either the yield adjustment or yield exclusions, endorsement, policy options. But with a 550 pound APH, you'd be looking at $306.90 worth of coverage for a cost of $31.57. When we put stacks on top of that, county's expected yield's a little bit better up there in Moore County at 332. So that band of stacks coverage, 70 to 90 with the multiplier, would give you a potential maximum payment of $74.10. And then with the subsidy kicking in, a pretty reasonable $9.22 cost for that extra $74 worth of protection. When we look at the Ark County offer, again, remember Moore County was an all cotton offer. So this is the same amount that it would be in play with the irrigated acres. And you can see that that Ark County value is almost the same as the stacks coverage. But that's really, the main driver of that is the fact that that benchmark yield is significantly higher and very much influenced by irrigated ground in the county. So it's a lot more reflective of an irrigated situation. But again, it kind of brings Ark County into play with stacks up in Moore County because the coverage amounts are relatively the same as far as how much you might get paid at a maximum payment. The trigger though is going to be so much better under the stacks regime, whereas you're going to be using that higher projected insurance price versus a harvest price, and the Ark County is going to be again going to have to suffer a lot bigger production loss if prices stay up in the currently anticipated range. Now price declines down below that 36.70. And you have some yield, maybe that brings Ark County into it, but still a relatively low opportunity for Ark County to trigger that $74 payment compared to the odds that stacks would trigger at $74 in payments. So again, stacks kind of wins that on the odds, but does come with the additional premium cost of $9.22. When we look at SCO, on that optional unit in dryland in Moore County, we see that the SEO band would be worth $132.99. So you can get, almost a little more than $50 more coverage under SEO than you could under stacks, or that would be available under Ark County. And of course, the downside there is the cost, that producer premium of $27.25. Pretty expensive, but again, you're getting a little bit more coverage there under SEO potentially, since it's being paid out based on the projected 550 pound APH of that producer example. The enhanced coverage option ECO in Moore County, again 4604 for a maximum payment and a cost of $17.74. So still a pretty expensive option for not a whole lot of net coverage at the end of the day, even though you would have a better potential to trigger with that higher 95% trigger point. Dawson County, going back down south, again, same yield levels that we use for Lubbock County, 400 pound APH. You can see that in Dawson County, that $223 of coverage though is going to cost you $41.40 for that producer premium. So optional units are pretty pricey when we're looking at the dry land. Looking at stacks with that example in Dawson County, 209, a very low expected county yield for dryland cotton in Dawson County for 22. So a maximum payment of only $46.65. But again, at a relatively reasonable cost of $6.20. So you can, if you achieved a maximum payment there, you'd be about $40 net. And when you compare that to the Ark County offer in Dawson County, again, you got a 621 pound seed cotton benchmark, which is very comparable when you look at the length pounds equivalent over there to that 209 expected yield for stacks. And the maximum potential payment on dry land in Dawson County, $22.81. So pretty modest maximum payment potential there for our county. That about half of what you could get coverage wise through stacks, and certainly a much lower potential for that payment to actually be made compared to stacks as well. Going over to the ECO and SCO options, again, you can see that SCO can provide you a pretty good amount of coverage, $96.72 at a cost of basically $21. And then ECO, you could get that 9% band there, value $33.50 roughly for about $13.75. So again, ECO is a pretty expensive option, cost for coverage, but SCO is certainly in the ballpark if you wanted to potentially add up to $100 worth of additional coverage over and above your underlying policy, looking at a 60% enterprise unit insurance revenue plan. We'll stick with the non-irrigated here and just look at some enterprise unit quotes that we can compare. And you can see when we go to enterprise units, we can certainly bump that coverage level up to 70%, which is what a lot of folks do, because that still gets you the maximum 80% premium subsidy, and it does not compromise the band, the stacks band. So you're not eating into or narrowing that stacks coverage amount. When we look at that underlying policy under an enterprise unit at 70%, you can see that we've definitely improved our guarantee by about $40-something, going up to $260.40 per acre of guarantee for a cost of $26.48. So right at that $10 a hundred mark that we look for to be kind of a reasonable cost for insurance. So enterprise unit certainly makes a lot of sense to get you a little bit higher amount of coverage, a little bit smaller deductible, and then a little bit lower premium. When we look at stacks, adding on top of that, it's the same as it was be under optional units. You're getting that full band of stacks, $57.36 maximum potential payment there for $7.19 cost. So that's a pretty good comparison there for producers to look at adding a little bit of extra coverage, get you a little bit over that $300 of total insurance for just under $35 an acre total stacks and the underlying plus the underlying policy. When we look again at that Ark County maximum payment, $23.14, really doesn't compare very well with the stacks potential that you would have. When we look at SCO, again, a little bit better coverage than the stacks pound for pound in Leavitt County, but again, you've upped your underlying policy to $260 for protection for $26.50. You add that $60 through SCO for another $12. You're still under $40 an acre for over $300 worth of total insurance on the dryland side. So that's a pretty good. It's not as good as stacks quite, but it's still pretty good for the coverage that you can get with those two policies combined together. And again, ECO being a relatively expensive, really top end product that most folks will probably choose to do something else. Moore County, we look at enterprise units. Again, we use that higher APH yield. So being able to bump up to a 70% policy there gets you almost $360 worth of coverage, $358.05, for a total producer cost of $23.58. So that's a really good cost for protection relationship there in Moore County when you're looking at enterprise units on dry land. Then we look at the stacks. And again, that's $74.10 maximum stacks coverage for $9. So, for just about $32, $33, you could get just a little bit over $400 worth of total insurance through a revenue plan with enterprise units, dry land, and stacks in this example. Again, that compares pretty favorably, all things given, considered against that Ark County option, and certainly would protect you when prices are at a much higher level and if they were to begin to drop. SCO, again, your underlying coverage is looking really good. SCO, when we have the higher band, is going to narrow that coverage band. So, we're only getting a 16% band of coverage under SCO here, but again, $81.84 worth of additional coverage for $17. Mostly a function of that premium subsidy difference between it and stacks when we compare that. Again, it's a little bit better yield, a little bit better coverage than stacks because of the APH difference compared to the county yield. But overall cost, stacks still probably comes out a little bit ahead in the grand scheme. But again, you could add SCO to this revenue plan at enterprise units 70%, and for right around $40, $41 an acre, have roughly $440 worth of total insurance protection potentially. So that's a lot of insurance for that $40. Still meeting that overall goal of $10 per 100 type of a cost. And again, we've already talked about the Ark County being an all cotton offer in Moore County. But again, going to take a pretty steep yield decline, given good prices, or really steep price decline given average yields for Ark County to come into play. So again, revenue, enterprise units plus stacks or SCO seems to be, a pretty good combo to consider going into 2022. Dawson County enterprise units, again, $260 worth of coverage with the 70% enterprise, using that 400-pound APH. Overall cost of $24. So, still right around that $10 a 100 underlying policy cost. You add the $46 that you can put on that through stacks for $6.20, and you've got a pretty decent package there to look at for the producer compared to the Ark County numbers. And then we'll kind of round this out. Dawson County irrigated, non-irrigated enterprise units on the SCO side. Again, SCO would give you the potential for about $60 worth of additional coverage for $13.59 cost. You add that to the underlying plan, and you're looking at somewhere around $320 worth of total insurance, SCO plus your insurance, for a total cost of right at $38 an acre. So pretty good relationship there, even with SCO and your underlying policy if you're going with enterprise units. And with that, I'm going to kind of wrap it up and just thank everybody for sticking with me today and listening, and then encourage you to feel free to give us a call, give me a call at Plains Cotton Growers. Our number's here on the screen. Go to our website, shoot us an email, and if you have a specific question, I'd be more than glad to try and help answer those questions, or point you to somebody that can help you get the answers that you need. And then again, I'll just close with an encouragement to talk to your AIP between now and the end of February, especially. Keep an eye on that projected price calculation and see how it's shaping up, and run some quotes and get some different different combinations there. See how you can utilize some of these program parameters to tailor make your safety net something, and make it something that'll work for you for 2022 at a reasonable cost, and hopefully give you a better potential level of protection than might be available through our FSA products as well. Certainly, we know that there are instances where we do need to go with those FSA programs, and then if that's the case, look and see, if you're going to be in PLC, what does that SEO endorsement look like on top of that to give you that little extra policy protection that you might be looking for in 2022. With that, I'll say thank you and appreciate your time.